Good morning, students. Today we are going to talk about second adjustment of admission of a partner, that is valuation and adjustment of goodwill. Before we talk about goodwill, its valuation and adjustment, I would like to remind you all of Accounting Standard 26. You all studied earlier. Accounting Standard 26 says that only purchased goodwill appears in the books of accounts. Self-generated goodwill does not appear in the books of accounts. Now, whenever there is an admission, a new partner enters the firm and becomes eligible to get share of profits in the future earning of the business as well as share of assets and liabilities of the business. For this, he needs to compensate the sacrificing partner, which is done in the form of premium for goodwill. Whatever share of goodwill he brings to compensate the sacrificing partner is called premium for goodwill. There are various accounting treatments of goodwill at the time of admission according to the different situations. We will discuss all the situations one by one. Case 1, where goodwill, that is premium for goodwill, is paid privately. Paid privately means outside the business. The settlement took place outside the business. Anything that takes place outside the business has nothing to do with the business, since the new partner paid premium for goodwill to the partners outside the business, so there is no entry in the books of accounts. Since the settlement took place outside the business, so no journal entry will be passed. Second case, where premium for goodwill is brought by the new partner in cash or by check and is retained in the business. What does it mean? That the new partner, he brought his share of premium for goodwill, he brought it in the business, then it has to be given to the sacrificing partners, but the amount was retained in the business. That means the ones who got it did not withdraw. We will understand this with the help of example. Suppose there are two partners A and B. C is a new partner who is admitted. Let us suppose their sacrificing ratio is 1:1 and premium for goodwill which C is supposed to bring is 10,000. So first journal entry will be for bringing in cash for premium. So journal entry will be cash or bank account debited to C's capital account. Let us suppose premium he is bringing 10,000 and capital he is bringing 1 lakh. To C's capital account, to premium for goodwill account. So 1 lakh he will bring as capital and 10,000 he is bringing as premium. So total he is bringing 1 lakh 10,000. Being capital brought, or being capital and premium brought by C. Now this premium has to be transferred to the sacrificing partner. We have assumed that the sacrificing ratio in this case of A and B is 1:1. So next journal entry will be premium for goodwill account debited to sacrificing partner's capital account, to A's capital account, to B's capital account in their sacrificing ratio. So it will be divided in their sacrificing ratio, which we have assumed 1:1. This was case number 2, premium brought in the business. And you see, although we have given the premium to A and B, sacrificing partners, but the money is still in the business. It has not been withdrawn from the business. This amount of premium, although it has transferred to A and B's capital account, but it is still in the business. Thank you.